Good evening, everyone. I am Dhruvi Ghosalkar, Senior Executive Corporate Communications at IFA Global and Billions. A very warm welcome to each one of you for joining us today and taking time out from your busy schedules. I'm confident this session will be both insightful and thought provoking as we dive into various asset classes and take a multi asset perspective with a special focus on Indian equities and their valuations. Let me now take a moment to introduce our host and speaker for today's webinar, Mr. Abhishek Goenka. He is the founder and CEO of IFA Global and Billions, which is the wealth arm of IFA Global. With over 2 decades of experience, Mr. Goenka has advised hundreds of companies, families across India and Asia, UAE, on foreign exchange risk management and treasury strategies. In recent years, he has also been actively helping some of them manage their family's wealth using multi-asset and multi-geography approach. His passion for creating value for clients, employees, and stakeholders has earned him several awards, including 40 Under 40 Young Entrepreneur Award and multiple financial market awards, both in India and the Middle East.
Thank you, Dhruvi. Well, my dear friends, very good evening to all of you. We call a guest, a distinguished guest from the industry, and today we have Pankaj. Pankaj needs no introduction. He's been a star fund manager for Kotak for a very, very long time. I think we both hail from the city of joy, Calcutta, the similar pedigree. Pankaj have been instrumental in running two very successful funds, which is the Kotak Emerging Fund and which is a mid-cap category, and of course the Kotak Small Cap Fund. And under his leadership, the fund has really grown. I think the last numbers which I recall, I think the fund started at 113 crores in the emerging category, and it went all the way to 36,000 crores, which is close to $4.33 billion. And the small cap also went all the way to 13,000 crores. And I think in the mid cap category, there was an alpha of around 1.7, 1.8% for almost 10 years. And in the small cap, the alpha was close to 4.5, 5%. So I think Pankaj has won numerous awards and been star fund manager and awarded by Economic Times, Outlook for multiple years. And now he took on an entrepreneurial journey. He's made a very successful AIF product. And Pankaj, where have you reached in terms of AUM now?
So it's just been 11, 12 months, and we are roughly about more than $400 million as we speak.
Awesome. So that's a fantastic journey. So today the intention, Pankaj, of course, we will have a lot of my clients from the export-import community, a lot of family offices, ultra HNI, and we cover aspects from a multi-asset, multi-geography angle and what's happening outside the country in India across multi-assets. And of course, you've been an equity expert. Would love to know about how you feel for equity. What's your style of investing? So we'll take this session in this structure, Pankaj, and let's make it a discussion. And I would request the audience also to make it as we can make it in a very, very discussion format. You can put your points in the chat, and so that we can enjoy the discussion for the next 1.5 hours. And we have me and Pankaj, and we love to answer all your questions. By the time the team is also there, and they would like to answer your questions whenever you put it in the chat box. So the structure of the session, as I was saying, is something like this. We'll touch upon what's happening across the globe. And there's a lot of debate going on between bond, equities, hard assets, because inflation is all across India versus Asia Pacific, US versus rest of the world. And Indian equity, the valuations, the earnings. Recently, a lot of factor funds have come into vogue. How do you choose a factor fund in case you need to? how do you decide between a mutual fund or AIF? And what's the asset allocation that Indian families are running right now? What's the right asset allocation so that you can get a decent return with low standard deviation? And of course, everybody wants to know what's happening on the gold, silver, and the iron front. So meanwhile, I'm just adjusting this, Pankaj. Why don't you just touch upon something which is happening in equities right now?
Sure. So, good evening, friends. I think two things first. I think from a macro perspective, specifically related to India, I think my sense is we are troughing down and incrementally things should start looking much, much better because the actions which have happened in the last 6 months have been pro growth. Compared to the last 24 months, which we saw was much, much tighter policies by both on the fiscal side as well as monetary side. And I think if you look at monetary, I think 1 lakh, almost 11 lakh crores of liquidity infused by RBI. The system was negative 3.5 lakh crores. System is positive almost the same number. And just to give you perspective, April-May data, 5.5 lakh crores of incremental bank deposit has been coming in. And as a result, now banks have started to slash the deposit rates. So I think from a liquidity and interest rate perspective, I think central banker has been super positive and super supportive in terms of growth. And I think that will start to percolate into micro over a 2-3 quarter lag. What you are seeing the weakness in micro today is a result of what has happened in the last 18-24 months because of tighter policies. And hence, my belief is that in the near term, markets will be in a consolidating phase, maybe 1,000, 1,500, 2,000 points on the equity in India. And over a period of time, I think this should, in by March quarter, we should start seeing strong earnings growth picking in, led by banks and other sectors. And FY27 should be a very strong earnings growth year. This year, we are expecting about 9 to 11% earnings growth, which will be better than previous year. And many companies, mid cap, small cap, can deliver 15 to 20% earnings growth for the next couple of years. So I think it will be a stock pickers market. Macro is tough down. I think incrementally you will see improvement in macro. What all the actions? Micro will take time of 2-3 quarter lag. And hence, this will be the time if you can find corrections like it has happened this month, or maybe global volatility. I think you should use that as to invest from an equity perspective. But the easy money, which we saw for 4 years, is behind us. Now you need to really work hard at the ground level to make your alpha. Compared to globe, I think it's a year of conflicts and the year of expect the unexpected. Why do I say expect the unexpected? In 3 months' time, from April trough 8th to now, US markets have rallied by 23-24%. This has been the fastest bear to bull market story which history has seen in the US markets. 12 weeks. In April 8th to now, 24% S&P is up. Why do I say expect the unexpected? Because if you look at the Iran-Israel war, everybody expected markets will go down, crude will spike, volatility will spike. The week after, S&P up 4%, crude down 12%, VIX down 12% or 24%. So expect the unexpected. Everybody thought tech story is punctured. 50 or 70% of the incremental market cap movement which happened in the last 12 weeks led by tech. So I think this year is a surprising year. And also on the dollar depreciation, dollar has been showing weakness from 110 to 96. And as a result, after a very long time, we are seeing global markets doing much better than the US markets. US is underperforming. And I think this may be a start of a new trend where dollar weakness can lead to a lot of flows to the rest of the world, including emerging markets. So these are some of the broader trends which we are seeing as we speak towards India and globe.
Great. Thank you. Thank you, Pankaj. globally, I think there's a lot of action. At one end, the tariffs, something which is giving sleepless nights to everyone. At the same time, Japanese yields, which was at 0%, has moved all the way to 3.5%. And there's a fear that the money which, because of the carry trade, has gone to the rest of the world might just come back to Japan back. As Pankaj was mentioning, the tech is going one-sided, and now stocks like Nvidia is holding 8% of market cap in Nasdaq. And the debt in America is again something which is very unsustainable. $36 trillion with $1 trillion of interest payments. And as the famous Ray Dalio says that in 3 years, US will default in case they at least 3-4%. So as I was saying, the Japanese yields have gone up, and the 40-year bonds are sitting in huge MTM losses. And the debt is like never ending, and every single time they are passing on new bills to increase the debt. Valuations are very expensive in America. I think the S&P is quoting at around 26 PE and Nasdaq close to around 30, which is very, very high. I think the global market cap GDP, I think, is close to 200% as per the Buffett indicator, which is very, very high. Now, well, this is something interesting, Pankaj, and would love to know your view also. Now, whenever the dollar has been weakening, and there are 10, 15 years of time when the emerging markets go up and then the America goes up. So from 99 to almost 2010 was a lost decade for America. And emerging markets were going up, and now once again, for a very, very long time, US was almost outperforming. And now the valuations in MSCI, especially in Asia, is rock bottom. And now we are seeing the money going across these markets in Europe, in Asia, in Japan, Korea, Taiwan. If you look at this chart, a lot of money is going across this. And of course, as the dollar is weakening, these markets tend to outperform America. So, Pankaj, what's your view? Because there's a huge debate where is US still investable under this valuations and dollar weakening scenario, or we should look at Europe, Japan, Korea, and other markets? Is it era changing?
Yeah. So just to put things in perspective, Abhishek, I think your voice is every 2 minutes it's fumbling. So I don't know whether the connection is bad or is there some other technical issue. But coming to your question, if I heard is right, is that
Okay.
how should we look at the US market? So let me give you a perspective. I think we are extremely cautious on the US market as you move ahead. There are 3, 4 reasons. One, I think the market concentration there is extremely high right now. And if you ask me, the AI hype is much, much larger than the tech 2000 bubble hype. And in my view, I think the concentration of top 10 stock in S&P is close to 37, 38%. And that I think is a risk one should not ignore. And a lot of large money has poured into that. And also to put things in perspective, over the last decade or so, 2014 till now, the non-US investor piece is now standing at $30 trillion. So from almost $7-8 trillion to $30 trillion has been the incremental M2M plus a new flow which has flowed from non-US entities to US market. It includes bonds, equities, everything except sovereign funds. And I think that's a large number because they have never seen in the last 10 years bad US markets. US markets have been compounding at 15-20%, and 70% of world market cap has been US. So why to bother about any other country in the world when US is giving you such fantastic returns with large sizes, large companies, large liquidity? I think that is going to change in my view because for the first time you have seen US markets underperforming. Though year to date they are still up by 6-7%, but the world market is doing far better than the US markets. You look at European markets, they are up by about 25-30% this year. Japan has been doing extremely well. Day before yesterday, Nikkei crossed 35-year top, which it made in the 80s. So I think global markets have done far better compared to the US. And my conversation with large asset allocators globally is suggesting that they are sensing worry in the US as far economy is concerned and as far fiscal deficit is concerned. And don't forget, we are standing at a $37 trillion debt today in the US. This number will likely move to 42 trillion in the next few years. And you have to refinance your debt, plus you have a deficit of $2 trillion every year to fund. That's a large number which we are looking at in terms of interest rate payments, and hence interest rates, dollar will be always under pressure. So there is a worry out there among large asset allocators as far fisc is concerned for the US, and hence they want to diversify either in gold, silver, hard assets, or to other markets where they are offering growth and margin of safety is very, very high. My sense is that last year we saw huge FI outflows in the India context, and whoever I speak to globally, Goras, they are saying that give us an entry point. एक entry point तो दे दो हमें from a valuation perspective. So I think I am not so worried about the FI flows into India this year and next year. I think the trend is changing, but the outperformance is US in the last 10 years is so huge that it will take a couple of years of outperformance of emerging markets and other developed markets to really shift meaningful money out of US to the rest of the world. So I think India will be surprised. And if market gives an opportunity from a valuation perspective, you will see a large amount of flows coming back to India. The first 3 months, April, May, June, has been a changer in terms of FI flows coming back. And you saw how in May and April, you saw markets moving up the wall of worry when FI flows started. So don't worry on that side. I think this volatility is a great time. The next 6 months could be a great period to start investing. I am not worried on FIs. I think US underperformance will lead to a large pool of capital moving to the rest of the world, is my belief.
Thank you, Pankaj. So I think me and Pankaj, we both are on the same thought that America, because of the huge bull run in US, the high debt, and the 10-year bond yields and 30-year bond yields in America is so high. And the world is giving a signal that it's going to be very, very difficult to roll over all the debt. So I think once again, the other markets are getting very lucrative. And as the debate, which is on very much hard assets versus financial assets, I think hard estate, commodities, gold, silver, and copper, etc., are getting very, very interesting in the current times. So I think that's a very interesting take. Great. So Pankaj, we'll touch upon some points, what's happening in terms of equity valuations and equity earnings. And would love to know your thoughts also. So in terms of top line, bottom line, profitability, and what the expected profitability for the next year or so, and how much returns can we expect out of large, mid, and small, looking at the current valuations. We can just look at some probability over there. So Pankaj, we can see that the sales growth momentum is slightly fading.
Yes.
It's around 7-8% in FY25. And so earnings, of course, on the mid cap category, the earnings have been pretty good. But on the large cap category and the small cap category, the earnings are falling aside. The good part is from the last 6 years. I mean, if I have to take into account before COVID also, I think the revenue grew by around 10%, which is nominal GDP growth of India around 10.5 times. PAT has grown fairly okay, 19%, and the market cap has compounded at 21% CAGR. There has been some re-rating in the equity markets in America, I mean India. I think that's the reason the FIIs are getting jittery in terms of valuations. So Pankaj, time and again, every year we are seeing the earnings changing, and there are times when there has been wars or elections or COVID years, because of which earnings have dropped. So what is your feeling, Pankaj, on FY26? What's the kind of earnings can we expect out of overall all cap index, and looking at what current valuations are in the market, how much can return, what kind of returns can we expect in the current market?
So Abhishek, I think there are 2 points to it. First, I think what is concerning is that last 8 quarters, we have seen corporate India, the top 500 companies, top line growth below the nominal GDP growth.
Correct.
And what has really pulled up the earnings from the last 5 years is the margin expansion. And that could be led by cost efficiency and many other things. But somewhere in many sectors, margins are hitting a peak. And for further earnings growth, acceleration to happen, top line has to pick up. And top line is a combination of both price and volume. Volume is okay, but price I think also needs to see because it's a after result of inflation. And inflation have been subdued in India for last few years. So I think for incremental momentum to pick up on the earnings side, I'm talking about over or larger base, we need to see a top line growth coming in. And unless that comes in, a major 15-20% earnings growth for all cap looks to be difficult. And on a larger 10, 15, 20, 25 years, if you look at in the history, normally the EPS growth over a period of time mimics your return on the market. Okay, so Nifty has given about 13.5% CAGR returns over longer periods of time. So has been the EPS growth and the earnings growth with marginal re-rating happening. So my sense is for the next couple of years, we are sensing that it will be 9 to 11% earnings growth for Nifty. FY26 again will be a 9 to 10%, better than last year, which was 4 to 5% as you have shown. So double of that, and hence market return should ideally mimic the EPS growth return. But on the mid cap side and small cap, I think the cash flow growth last year was also better than large caps. Earnings growth was also better than large cap. And this year also, the first quarter has started with that kind of a trend. So our sense is that this is going to be now a stock pickers market rather than taking a big sectoral or a macro call and saying that where is the thing. The alpha would be generated if you can pick up the right stocks and right sectors, and the time is gone for buy and hold perpetually कि मैं लेके सो जाऊंगा अब वहीं पर पैसा बनेगा. I think the sectoral rotations are happening at a very fast pace, and you need to be agile on that front as well. So 2 years, I think earnings momentum should be in early double digits because top line has been weaker, and so should be the earnings expectation from the market. If you can identify right spots, I think you can generate a 2-3% alpha over and above that. I think that should be the right expectation one should carry rather than the easy 4 year, 5 year money where every manager is showing you 25-30% return. I think that's not sustainable, or one should not expect that as you move ahead into the next 1.5, 2 years.
Got that. Great. So Pankaj, very, like we quickly said that of course the top line has been a worry. And of course, inflation is coming down. So the overall top line is not going up. That's also adding to the woes. And I think, Pankaj, the profitability in terms of by reduction in costs, etc., has hit around 15.5%, which is the max India hits. And we are close to the top end of the curve. And there's not much room for the overall profitability to improve, right? So top line has to go up. Otherwise, we are not going to see the earnings coming up.
Yes.
Right. Pankaj, now there's a lot of discussion on mid and small, that small cap is quoting at a 52% premium. This is what Nilesh Bhai's slide is showing. So if one has to invest in a small cap today or a mid cap, of course things are very expensive, and at the same time top line growth is not happening. So if we are expecting earnings to be in 11-12% or something like that, and obviously there is some froth in the market. So at even these levels, do we expect to make that kind of a return, or it's anybody's guess?
So in February and March, Abhishek, we wrote in our quarterly newsletter that the narrative of sell mid and small and move to large cap is not the correct narrative. And we gave 4 or 5 reasons for that. The first reason was that the headline valuation which you are seeing today doesn't portray the right picture. Why I am saying that? You are seeing 20% premium to historical average, certain other things. But if you go back to your previous slides, 2, 3 slides back, where you showed the large cap earnings growth, mid cap earnings growth, and small cap earnings growth, you will see that in the mid cap 150, the earnings growth last year was 29%. And in Nifty 500 was 7%, and Nifty piece was, say, assume flat. So the flat earnings growth, you are paying 21, 22 times forward. For a 29% earnings growth, you are paying 27p or 26p. So ideal way to look at is the peg. Is the peg is not peene wala daru ka peg, but it's the peg of price per unit of growth which you are paying for it. And most of the times we get stock calls and market calls wrong in a fast growing company or a sector because people don't focus on PEG, people focus on absolute PE. And it's learned by the hard way that valuation is the horse, growth is the horse, valuation is the cart. Till the growth comes in, valuation will follow. The growth slow down, valuation gets derated. And hence, mid caps have been growing at a much faster pace than large cap. So on a PEG basis, it's not very expensive. For a 20% growth, assuming or a 15% growth, you're paying 26, 27 times. For a 9, 10% growth, which is expected to be there for Nifty, you're paying 21, 22 times. So don't get just swayed by the headline narrative on PE. That's one. Look at the context with earnings growth. The second point which I wanted to derive is that 50% of the profit pool of large cap comes from low PE sectors like oil and gas, banking, PSU banking, and PSUs. These are perpetually low PE sectors. And 50% of the profit pool of Nifty lies in these low PE stocks. On the contrary, on mid caps, the low PE sectors, which I just mentioned, is about 16, 17%. So if you strip around that 16, 17% equally from both and do a like to like of non-PSU, non-banking, non-oil and gas, the Nifty is trading at 29 times, 30 times compared to mid caps, which are at 26, 27 times. So devil lies in the detail. And hence my view is, and only request is that don't paint the entire sector with the same brush. There is a merit in mid and small cap. If the earnings growth is there, they will deserve a premium. And in an environment where earnings growth is scarce, companies which can consistently deliver 20-25% earnings growth, market doesn't know whether it's a large cap, mid cap, small cap. Exchange को पता नहीं है. Exchange को पता है कि earning growth आ रहा है, market को पता है earning growth आ रहा है, reward them. So I think one has to be clear about that. And in every market, there will be excesses, in especially mid and small and SME segment. There are pockets of excesses. One has to avoid that and navigate it along with it. So the narrative was in Feb, March, sell mid and small. Now in 4 months, 5 months, look at the performance. Now nobody is talking about it. Nifty 500 is up just by 4-5%. The fund is up by 13-14%. Index is up by 8-9% on mid and small. So there's been a sharp outperformance which is
So no, very, very rightly said. And Pankaj, one takeaway for everybody who's sitting here, and every time they can confused in terms of large, mid, and small. My dear friends, as Pankaj was saying, that look at the PEG ratio and just not look at the PE ratio, because the mid cap earnings are fantastic. And if the stocks have amazing earnings and markets does not know whether it's a large, mid, or small, if the earnings compound at 2025, the stock also compounds similarly. So one has to look at earnings and just not at PE, and accordingly take a position in your large, mid, or small cap accordingly. So Pankaj, a lot of people have also raised concerns in terms of Capex, that government is doing its part, the private is not doing its part. But when I look at the numbers, this first time I think the private Capex have surpassed the government Capex. So I think the Capex is fairly okay. I think because of uncertainty, people are not biting the bullet because of America, etc. But still, it's an upward trajectory. What do you think on this?
So yes, Abhishek, I think private sector capex has also started to improve. And let me give you one more data point. This is all the listed companies you have mentioned. But when I look at the top 500 companies of India, and you remove the financials, which is the banks, the NBFCs, MFIs, mutual funds, and so on and so forth, wealth platforms, and all that, you're left with 390 non-financial companies. And last year, their capex number was about 8 lakh crores of these 390 companies. And out of that, 1,76,000 crore was PSUs. So if you remove that, you're left with about 6 lakh something odd lakh crores, 6 lakh 25,000 crores. And out of that, about 50% was done by top 15 corporates of India, which is Reliance, Adani, Aditya Birla Group, Murugappa Group, Tata's, so on and so forth. So the only thing is the headline numbers have started to improve, but the breadth of capex has to start improving as well. Today, 50% of ex-PSU capex is done by large 15, 20 corporate groups of India. If that moves to 50, 60, 80, 100, I think then the wave of optimism on the capex will start to build in and investment cycle will be supported. So my sense is we are moving in the right direction. And last, any capex cycle you look at in India, it was driven by cement, metals, refinery, and few other ancillary. Now the incremental money will be spent on renewables, which is the green energy completely on solar panels, solar cells, entire installation on the producer side. You will have new areas like hydrogen. You will have semiconductor plants being set up in India. These are large capex items and incrementally new energy part. So I think the flavor of the capex has started to change. And in the next 3 years, my belief is further it will change. And it will be the entire building up of the new ecosystem which India has never seen. Metals, refineries, cement, all were there. So you're adding over that. But you are creating an entirely new system, an ecosystem on new energy, semiconductors, and others, which will create ancillary industries along with it. So my belief is that one starts to look at capex also a little differently by corporate India because new areas will come for capex, which we have never kind of seen in the past. But the step is in the right direction. I think after corporate, Indian companies are also started to see some momentum on the capex. Only thing is the demand is an issue right now. If they start seeing a demand pickup also, it will give them a lot of confidence to expedite that capex faster.
Got it. Pankaj, I was hearing one interview by Mr. Parekh, and there was a conversation happening with Mr. Kocher and Mr. Parekh, and where he was saying that the capacity utilization have hit fairly okay, around 75-76% in the overall industries, but banks are reluctant to lend. So in that case, a lot of money is not flowing in the system. So is that also a concern? And that's also a reason why the private credit market has really picked up in India in the last 4-5 years. What is your opinion on that, Pankaj?
Yeah, so after the NPA cycle, it's always there that, banks become a little careful and cautious in lending.
Yeah.
And that has been the case in India also. But incrementally, if the deposit accretion is going at a pace which I have talked about, that in 2 months in April, May, we saw 5.5 lakh crores of deposit accretion. Banks will be forced to think about lending again. And the risk matrix by RBI has been reversed. Risk weightages across NBFCs and banking. So my sense is risk appetite should come back maybe in the next 6 to 12 months. And I think there's no dearth of capital. If your project IRR, your project viability is there, I don't think banks are, say, shying away from not doing a project lending. But obviously you have to show it on paper or actual that the project is viable. I think gone are those days where you can fund anything anytime.
So now coming to the $1 million question, which you also said, कि FII पूछ रहे हैं कि मुझे entry तो दे दो market में. So earnings are nice, inflation is okay, currency is stable, fiscal is okay, current account is okay. See all the tick marks, but FII holding is rock bottom. I think it's never been so low, right? So why are they not investing? It's only the valuation, because they're investing the rest of the world, but they're just not coming to India. क्या
See, I
लगता
think
है?
that's obviously valuation is a headwind, and that's why they have been staying away. And last year, see, why do FI come to India for growth? Okay. And last year, growth was a challenge. That's why when you saw the September quarter GDP growth coming in October, you started to see FIs trailing off very aggressively till March. And after the fourth quarter numbers started to come in and US dollar depreciation started to happen, you saw the turnaround of events also very fast. But एक चीज मान के रखो कि अपना मार्केट बहुत एफिशिएंट है. जैसे गोरा आता है वो अपने को शाम को पता चलता है, बट स्क्रीन अपने को दिखा देता है कि गोरा आ गया है. So market is very smart enough to recognize that. And अगर आप ये सोच के देखो मार्केट 24,525 पर खड़ा है without FI support and this being a decadal low kind of a number, अगर FI flow आया तो ये भाव मिलेगा क्या आपको वापस? वो आपको ऊपर में ही इन्वेस्ट कराना पड़ेगा, because फिर market is always smart to kind of understand that. So always think about that markets today is at a level without FI flows, and if dollar depreciation becomes more prominent, money will flow to countries like India. And if in a year we get 10, 15, $20 billion back again, can markets be at this level again? So my sense is that FIs will come back. I'm very, very confident about that. And any opportunity, if it comes through any reason, I think they will be bought by FIs very aggressively.
Agree. In fact, Pankaj, I was discussing this with one of the very, very senior personalities in the equity market. We met on a flight and he said, market will hit 30,000. अभी तो FII आया भी नहीं है. 25-30 हजार करोड़ डोमेस्टिक का आ रहा है, वो तो नहीं रुक रहा. वो तो एक स्ट्रक्चरल शिफ्ट है. अभी तो FII आया भी नहीं है एंड वैल्यूएशंस महंगे हैं. का टाइम पे 5-6% गिर भी गया, 10% गिर भी गया. So I think what mutual funds in arbitrage and debt funds and cash would be more than 5-6 lakh crores. Pankaj, comfortably.
अगर आप BAF का equity allocation देखो, ideally they can go up to 75-80% equity allocation. They may be around 40-45%. You have cash on the books of most of the funds, 5-6% on an average. और plus आपके पास arbitrage के funds का size बड़ा हो गया. So I think you have a 3 to 4 lakh crores के बीच में ammunition at any point of time from an industry perspective.
Plus 25,000 crores coming every month.
Plus EPFO है, ये है, वो है, तो वो सब तो अलग है ही. But मैं बोल रहा हूँ कि ammunition अच्छा build हो गया है. That's why FI बेच के गया इतने दिन से. ठीक है, बीच में थोड़ा फर्क पड़ा, but इतना market नहीं तो crash हो जाता था. So that is not happening anymore right now.
Correct. So just for the audience, just look at a bigger picture. At one end, in America, people are trying to look at other asset classes around the world. India is a high growth market. We are the fastest growing in the world. And of course, we are slightly expensive. We are currently supported by domestic money. FII holding is all-time low. Ideally, the money should come in from an FII. They're just not getting an entry because of valuations. But once things starts little lucrative in terms of valuations and we start seeing some money coming from the FII and the domestic flow and the dollar depreciation globally, then I think there will be a time when suddenly the markets are going to go up. So if you are not invested in the market, then possibly you may not get a time to invest. So whatever your equity allocation is, one should look at investing if you get some corrections in the market, but if you're expecting that you're going to get this market 20, 25, 30% cheap, then until and unless the growth falters, I think you may not get the market so cheap. Am I right, Pankaj?
Absolutely. Absolutely. And that's been the case previously also, right? So वो
Yeah.
तो चलता ही रहेगा मगर market में there's a saying that you have lost more by waiting than investing. So I
Correct.
think and classic case was March also again. So I think
Yeah.
you have to respect valuation. You have to respect markets over a period of time. But I think next 3-5 years, I think the kind of action which is going on at the ground level, and if top line starts to recover and FI flows follow it, I think markets will not give you a chance later on. Next 6 months could be a great time where you start investing for 27 and 28 earnings growth.
Got that. Of course, the balance sheets are pretty fine. So even if we see some sell-off in global equities, possibly we may not see a lot of sell-off in India. Of course, volatility can be there, but because balance sheets are fine, debt equity is okay. तो ऐसा नहीं है कि कोई बहुत बड़ा फटेगा in case of India. So Pankaj, now of course you're a public equity guy, but because we do business with some family offices and unlisted in places like Calcutta, Bombay is very much in vogue. I would like to pick your brain in that. Now there is a huge public market available. People still like to buy NSE. How should you approach unlisted equity space? And what are the things which are not to be done? I insist not to be done because people get very excited with the unlisted space. And we recently saw the listing of HDB where the discount was pretty large. And suddenly people were caught aback. So Pankaj, with your experience, how should you take into account the unlisted space? Whether it really makes sense for a family office to get there, and if yes, what are the things he should be very cautious on?
So I think whatever we filters apply for public has to be applied for private. And I think all family offices are invested in NSE. So they have made money, and that's led to the unlisted world getting discovered, risk appetite getting created. But not everything is NSE in terms of easy business, cash flow generating business. So our only recommendation would be that understand what you are buying first. Second, what price you are paying for it. Don't get too carried away by what the market momentum is. And classic couple of stocks which you mentioned have been the classic recent cases where the discount was far higher than the pricing which was trading in the gray market or the unlisted market. If you remember, a year back, Tata Tech came in. They also gave a discount. Then you saw now HDB Financials. So if you pay a wrong price to buy just on the momentum, I think you will make a mistake. So I think same filters on stock selection and pricing, you have to clearly see what you are paying for it. Many a times listed companies, listed peer sets are available at cheaper valuation and people go and back the wrong horse at a wrong price. So I think there you have to avoid such big mistakes in my opinion.
Yeah, agreed. In fact, one more point I would like to add is that in private markets, of course, the prices are very opaque. You end up paying a huge transaction cost. At the same
Yes.
time, they are not in the real market. So you
Yes.
don't even know how the market has, they've not even stayed 6 months in the market, and the market forces have not tested the price. So it could be artificially inflated because it's small hands, liquidity is not enough. And as soon as it starts getting listed, the true price comes in. In fact, Pankaj, in terms of NSE, if NSE have given a great appreciation, even BSE has given a great appreciation. So ऐसा नहीं है कि unlisted में जाने से ही return बन सकता था. Even Bombay Stock Exchange have given a great return to the shareholders.
और ये चक्रव्यूह है, अंदर आना तो पता है, बाहर कैसे जाओगे वो पता नहीं है.
Correct.
Don't think everything is NSE.
Yeah.
I think everyone can make mistake. I know people, many companies like Pepperfry, कितने papers उनके पास पड़े हैं वो आज के
uh,
6% भी वैल्यू नहीं है उनकी, तो अब बेचेंगे
correct,
किसको? अब कोई एग्जिट ही नहीं है आपके पास।
correct, correct, correct.
अगर आपको याद है
So,
फार्मीजी आया था,
80%.
कितना पैसा निकला। सो ठीक है, मतलब आई एम नॉट रिकमेंडिंग एनीथिंग गुड और बैड, बट व्हाट आई एम सेइंग इज दैट नॉट एवरीथिंग on unlisted is bad or everything unlisted is good. So first
Yeah,
filtration has to be done rightly, and then what price you are paying is also very, very.
correct, correct, correct. No, that's a very interesting takeaway, my dear friends, that uh, as Pankaj was saying, everything is not hunky-dory. And out of 20, one has done well. But you will find a similar stock in public market also. And you end up paying 2-3% as transaction cost with your wealth management broker. So just be careful on this front and really know that what price and what product are you entering into. And do you have the capability of understanding the financials and the cash flows? Because
Absolutely.
markets have not listed it. Now, Pankaj, I know we markets are a slave of earnings, but I was reading this article and I could not resist putting it here. Sanjay Bakshi of the Flame University said, अगर 22x का पी के ऊपर खरीदोगे तो अगला 3 साल नेगेटिव रिटर्न होने वाला है एंड दैट्स अ बैक टेस्टिंग डेटा एंड देख के सेंस भी थोड़ा समझ में आता है कि हाँ हो सकता है ऐसा. व्हाट इज योर टेक? आई मीन हिस्टोरिकली ऐसा देखा गया है कि अगर 22x के ऊपर खरीदोगे तो नेक्स्ट 3 साल में नेगेटिव रिटर्न आएगा.
So maybe Mr. Bakshi has done, हो सकता है कि सही हो. Full respect for him. But the point which I only wants to say is that it would depend on earnings growth. So अगर आपको
Yeah.
वही चीज लग रहा है कि forward is 22 times, but earnings growth surprises you and it becomes 20x, then what it is. And the second important point is also the bond yields. So if you look
Yeah.
at Indian bond yields, in January, February, it was 7 quarter. Today, it's 6 quarter. So 13% bond yield jump has happened in terms of bond prices. And ideally, your 13% P re-rating has happened. So people who were
Yeah.
looking at 22, 22 and a half in the last previous correction, saying that 20 to aane wala hi hai. And ideally that 20 base has now become 22 and a half, 23 base because of the
Yeah.
13% re-rating in because of the bond yield fall. So it
Hmm.
is combination of everything. You can't say blindly that 22 is a mark where you will not make money. If in India, suppose interest rates move down to 3%, so
Yeah.
P re-rating will automatically happen more.
Correct.
So never say never. And I think one has to look at from the other variables which determine a P ratio.
Correct. Correct. No, very rightly said. So I just like to repeat that. So even I feel that there are some of the moving parts. One is earnings and one is the interest rates, what Pankaj said. And maybe we see a quarter point cut more uh, because of RBI. If that happens, then obviously there's some more re-rating that can happen. And also one thing, Pankaj, is time correction. So if the time correction
Yeah,
happens, already the markets have fallen down today. For some more days, it's range bound. 3-4 महीने 5 महीने निकल जाते हैं तो वैसे भी वैल्यूएशन थोड़े नीचे आ जाएंगे. So
sure.
automatically then it becomes a lucrative price. So one has to also take into account the time correction, the valuations also correct automatically, and then keep a track on earnings and growth. And if that is
Yes,
fine, then there is nothing to worry as such.
absolutely.
So now, Pankaj, we come to you. Now you are a stock picker. You run a fund, uh, and I know every day you are glued onto the screen to understand which is the next great stock that you need to buy. And I could see that in your Kotak Emerging and Small Cap, I think the best stock performed 45x. Correct?
Yeah, slightly more than
In
that.
slightly more than that in that period of yours. So I would like to know your philosophy of how do you pick stocks? What's your code of conduct at office? And what are the things which you have learned, which which you have decided that this is not the ones I'm going to do. So not to do list में वो है. So let's discuss on that.
So Abhishek, I think our clear thought is that survival is important and growth is accidental. अगर आप survive नहीं करोगे तो growth कहाँ से आएगा? So the first point is always to make sure you don't make big mistakes and there is a downside protection always. Otherwise, you will be out of the game very soon. And our markets are in a way charitable and not charitable also. So if you make any big mistakes, markets will throw you out very fast also. And we have seen with the legendary investors in the past, the cycle and the shelf life continues to be very small. And you can count on fingertips how many people have about 25, 30 years old experiencing cycles and managing active money. So that means your ability to make less mistakes is always very important in the market. If you make less mistakes over a period of time, success will come to you, compounding will come to you. How do you, it's easier said, but in that context, what not to do becomes more important than what to do. And we always invert the situation and ask what are the things which have led to stocks becoming penny stocks. So clearly, one important thing we have seen is cash conversion. So as I've always said, top line is vanity, bottom line is sanity, and cash in bank is reality. Finally, if cash flows are not seen over a period of time, one bad cycle will kill you and the balance sheet, despite of top line, bottom line going up. And in our recent quarterly newsletter, we have focused in detail about why cash flow conversion is important, and especially in this market where people seem to be again forgetting the basics of investing. And I think finally, equity value is nothing but projected cash flows discounted to present. And if you don't have cash flows only, then what will you discount and what will be the equity value? So basics, I think one should not deviate. The second important thing is that tigers don't change their stripes. So if a promoter's niyat is bad, intention is bad, whatever good business you buy in, thinking this will be happening, that will be happening, finally you will lose your money, shirt, pant, everything. Because the promoter, the largest skin in the game player, is not interested in creating wealth. So choosing the right jockey, I think is very important. Otherwise, you will lose money. Otherwise, you will lose money. So I think keeping to basics and having a slightly longer term road, I think, which is patience, because never any company has gone through a linear phase of growth. There will be disruptions in between. There will be headwinds from the external marketplace. And if you can sustain that and ride with the company over a period of time, that's where the actual wealth is created. And I always believe that you have to back the right people, because people create businesses, businesses create wealth. If people are not right, how will the business get created? How will the wealth get created? So back the right promoters, back the right balance sheet cash flows. Make sure that you don't invest at a very wrong price, because finally we have seen the best of the companies. If you buy Borivali flat at a Malabar Hill price, God save you. So clearly the price which you are paying has to be also looked in conjunction. Otherwise, you will get stuck for a long time from a time correction perspective. So these are few basic parameters. If you keep in mind, you will make less mistakes. And just to put things in context, there are 5,000 plus listed companies in India. 36 are traded on a daily basis, even one share suppose. And out of that, only 600, 500 companies are serious investing companies. So the universe seems to be large, but it's actually not very large. And hence you need to eliminate. And I always say people that process of elimination is far stronger than process of selection. अगर आप eliminate करते चलो, तो you will be left with a small bunch of universe where you can then use your team energies and your energies to focus and go into greater detail. So sounds simple every day, but we are doing and trying to be core to our job. And last but not the least is integrity. I think one thing which I have seen very closely over the last 25 years is market is extremely smart than all of us. And if you do any hanky panky, market is a small porous animal. It will know everything within a very short while. And the reason people trust you with money is because of an important factor called trust. अगर trust नहीं है, तो trust me, over a period of time, in your bad times, nobody will give you or stand with you. And hence, I believe that how you conduct yourself in your portfolio, in your personal and professional life is also very, very important. And last but not the least, I think cutting the noise. There's so much of noise every day, and the horizon of every investor is become quarter se quarter. And there, I think we long only guys can have a significant edge where you expand your horizon to a slightly longer period of time and be patient. And the real impatient guys will give you the stock at a lower price. And that's where, markets trying to test you always. And I think these are the few things which are with you. What happens in the market is beyond your control. What will US do to China? What will Fed do on interest rates? All these variables are beyond your control. What is under your control is your process. What is under your control is your temperament. And how do you conduct yourself over a period of time? That's it. And if you have control over those, I think overall the outcome will be quite good.
Correct. No, very rightly said, Pankaj. Of course, as I'd like to summarize what Pankaj was saying was, of course, look at the cash flows, not only the profits. The money which is collected in the bank is what is real money. And you have a lot of ratios which can show you that. Second is integrity of the promoter. If you get a bad apple, you're never going to make money. 1 quarter is enough to take all of your money. In fact, Pankaj, we were discussing some time back and you were saying that agar somebody, female member of the family is not there in the board, तो वो कंपनी को मत खरीदना.
नहीं,
तो
ऐसा
उसको
नहीं
पहले
है. I
अगर
think
निकाल
that when
मतलब
what
उनको
we have
निकाल
learned
दिया
from
है.
what we have learned from our mistakes is that why did companies fail, and we went into details and saw that one of the processes was that whichever company went penny stocks, the promoter never kept the lady family member as a part of the board, which goes back
Correct.
to SDFC's philosophy. So if you go to
Yeah.
SDFC's philosophy of underwriting housing loans, you always used to take guarantee from the lady family member of the house. उससे
Yeah.
गारंटी लेते थे, पर्सनल गारंटी. क्यों लेते थे? क्योंकि प्रमोटर ट्रबल में आ सकता है, उसको ओके है, लेकिन वो लेडी फैमिली मेंबर को कभी भी ट्रबल में नहीं देखना चाहेगा. And hence you have the
Correct.
lowest NPA cycle for SDFC for decades. And that's what
Correct.
I think is also applicable for Indian equities. There are reasons promoter may not keep it also because of compliance, because of board director liability and all that. Because in a manufacturing firm there could be fire, board of directors is liable. Those are genuine issues. But normally we have seen that whichever company has gone burst, they never kept the lady family member generally as part of the board member. So it became as a hygiene check for us, as a selection process, nothing more than that.
Got that. So Pankaj, since अभी इतने सारे टाइप के फैक्टर फंड्स आ गए मार्केट में, and when the market was roaring bull market, people were riding on momentum funds, and suddenly अब बात हो रही है कि भाई क्वालिटी चलेगा, क्वालिटी 4-5 साल से नहीं चला. So if you have to get a gut, or if you have to see that आपको next factor क्या पकड़ना है. I know earnings is the माई-बाप of everything, but still, if somebody wants to get alpha, not by selection of stock, but riding the type, तो कैसे पकड़े? How does one look at that?
See, I think one factor which has worked in India very well over last many years, and there are very short periods where it has not worked, is momentum, right? So momentum has generally created that alpha for you for a long period of time. But in this market, I think low volatility is very important. Quality, I think, is very important. Quality has underperformed over a period, and growth. I think these factors, if you keep a good combination, should do well over the coming years. My sense is market is transiting from pure beta and value towards low vol, quality, and growth. So clearly, that's the change we are seeing right now.
Got that. Got that.
Uh,
So if you
Amit,
have a, yeah,
just to keep a little tab on time, I have a 6:15 meeting starting on, so they're just 5 minutes.
okay, okay, got that. So Pankaj, would like to pick your brain on this. Now, there are very good mutual funds, which is very tax efficient vehicle, and you have worked and you have been running a very successful fund for a very long time. Now, uh, there are lots of PMSs, AIFs in the market, and as an investor, a lot of these HNIs and family offices I discuss, they're sometimes confused because यहाँ dividend पे tax नहीं लगता है, short term capital gain tax नहीं लगता है, entry exit में. So one, when they come and choose a AIF, and they're definitely looking at some additional return after expense, tax and carry. तो पंकज कैसे choose करें that what should be the system to choose uh, an AIF apart from a mutual fund, or is it something like ये fund manager is mutual fund space में नहीं है तो मुझे अगर ये fund manager चाहिए तो मुझे ये AIF में आना चाहिए, क्या strategy
Yeah,
होना चाहिए?
I think see, color of the money is green. It's just the name of the platforms. Obviously, mutual funds today enjoy a better tax treatment compared to the other vehicles, right? But within mutual funds, within a category also, there are worst performing funds, there are better performing funds, right? And the divergence
Correct.
we've seen can range from uh, 1 or 2% to maybe 10, 15, 20% also. So there are all kinds of within that platform also. What I would strongly recommend is that you should know which institution you are backing, one, from a process perspective. How has been the fund manager's track record over a cycle, which means during good and bad times, how he has managed the fund in terms of downside protection, whether he is a momentum guy, all those study you need to do, and then leave it to the managers to perform, irrespective of whether it's a platform called AIF PMS or a mutual fund. Finally, there will be half a 1% differential, which can happen in a mutual fund category also. So if you choose a wrong mutual fund manager, and for 3, 4 years, if they're consecutively bottom quartile compared to the top quartile guy, any which ways you will have a large differentiation, isn't it?
Yeah.
Compared to the debate of PMS AI versus mutual fund. So I would strongly recommend ki have that focus in mind, and then that will help you over a period of time.
Got it. So what Pankaj also says is that its platform is agnostic. Choose the guy who has at least seen a few cycles, and then back him with whatever he is good at. So broadly, I think from a dollar rupee perspective, I think things are great. I mean, the balance of payment looks very, very comfortable, and crude is at $60, $70. We are fine. Rupee is overvaluation of rupee is corrected, so underperformance is very, very unlikely. Chinese yuan, which India tracks, has kind of appreciated, in fact, in the last couple of months. And broad dollar weakness is there globally, and inflation is low. And RBI has been keeping a floor at $84, $85 and building the foreign exchange reserves, which ultimately they want to take to $1 trillion. So I don't see any negative as such for rupee. I mean, whenever rupee depreciates, then I think one should sell dollars and buy rupee. That's the broad view that we have. And Pankaj, you would like to add anything on this?
No, I think perfectly fine. I think current account has been under control, but only worry is the capital account. So if you look last year, the FDI flows on a gross level was about 45, but at the net level it was 0 because
Yes.
a lot of corporates sold off their stakes and remitted the money. And the second was the outbound FDI, where Indian companies are acquiring stake in overseas companies. So the net FDI was 0. Now the call we need to take is incrementally, will this 0 go to negative or will this 0 go to positive? Being a little bit of optimist, I believe that this number is troughed and probably you should see net FDI also getting to positive territory. But that's one point you should keep in mind, that capital account is not in the best of the shape. Last year we had FI outflows, we had a FDI being net zero. I think that is something which has checked the currency always. And
Yeah.
hence this year we have to see FIs have, okay, July month they have started to again sell. FDI we have to see towards the this calendar and fiscal year, how does it behave? And that I think will be the swinging place between BOP, balance of payment.
Yeah. Yeah. Correct. Great. So with this, Pankaj, you would end this webinar. Thank you. Thank you. Thank you so much,
Thank you
Pankaj,
so
for
much. Thank
joining
you,
us.
Abhishek. Thank you so much.
And thank you so much for your time.
And have a great time, all of you who have logged on to the call. Thank you so much.
Thank you. Bye. Thank you so much, everyone, for spending time with us today and taking out time on this Friday evening. And look forward to engage with you in the coming sessions when we keep getting guests from all across the world on various subject matters and various asset classes in India, outside India. And thank you for supporting this cause of the Billionaire Investing Series. And stay tuned for the next sessions. Thank you.